The world of high finance is often shrouded in mystery, but at its most dynamic edge lies the hedge fund, an investment vehicle designed not just to grow wealth, but to protect it from market downturns. This exploration delves into the fascinating history of these funds, tracing their evolution from a simple, clever idea into a dominant force in global economics. It is a story not of dry theory, but of iconoclastic personalities and their revolutionary tactics for beating the market. By examining the triumphs and philosophies of the field's most legendary figures, we uncover a playbook of sophisticated investment strategies that challenge conventional wisdom about risk, analysis, and the very nature of markets. The foundational concept, pioneered by A. W. Jones in 1949, was elegantly simple yet radical: a hedged fund. Unlike traditional investors who simply buy stocks hoping they rise, this approach mixes long positions with short sales. Going long is the classic bet on a company's success. Short selling, however, is a wager on failure, borrowing shares of a company deemed overvalued, selling them immediately, and hoping to repurchase them later at a lower price to return to the lender, pocketing the difference. This dual approach creates a portfolio designed to profit in various market conditions. If the overall market rises, the gains from the long position should outweigh small losses on the shorts. If the market falls, the profitable short sales cushion the blow from the longs. This core mechanism of hedging is often misunderstood as pure gambling, but its original intent and most disciplined application are fundamentally about risk management. This principle of calculated caution is a recurring theme. While the public image of the hedge fund manager is that of a high-stakes riverboat gambler, the most successful are often profoundly risk-averse. Their personal wealth is typically tied directly to the fund's performance, creating a powerful alignment of interest with their investors. There is no government safety net. A string of bad bets leads to oblivion, not a bailout. This fosters a culture of intense scrutiny and accountability, where every position must be justified. The real gambling, the narrative suggests, has historically occurred in the less constrained, debt-fueled halls of large investment banks, not in the tightly run hedge fund. The story truly ignites with the advent of the modern titans. The firm of Steinhardt, Fine and Berkowitz took Jones's model and injected it with unprecedented scale and daring. In the early 1970s, new market structures allowed for block trading, buying and selling enormous chunks of stock at a discount. Michael Steinhardt, a figure described as possessing a gambling gene, had the vision and nerve to operate in this new arena. His strategy was straightforward: bet big to win big. This approach yielded legendary coups, like turning $1 million profit in 8 minutes through a rapid-fire block trade. He demonstrated that sheer scale, coupled with conviction, could itself become a strategy, thriving even during the inflationary turmoil that bankrupted many contemporaries. Meanwhile, a different intellectual approach was being forged at Commodities Corporation. Founded by a scientist, F. Helmut Weimar, this firm applied rigorous, almost academic analysis to predict price movements in physical commodities like cocoa and wheat. They initially focused on fundamental factors: weather patterns, crop diseases, production reports. A near-fatal misadventure betting against corn prices taught a harsh lesson about the limits of pure fundamental analysis. From this ashes, the firm pivoted brilliantly. They began to study the market itself, specifically, the psychology of its participants. They identified a powerful feedback loop: rising prices attract more buyers, pushing prices higher still, and falling prices trigger panic selling, accelerating the decline. By leveraging this insight, they learned to ride the trend, buying into initial upward movements to amplify the momentum. This shift from analyzing things to analyzing people's reactions to things marked a major evolution in trading strategy. The game changed entirely with George Soros and his quantum fund. Soros looked beyond stocks and commodities to the grand chessboard of national currencies, which were then considered stable instruments, immune to speculation. He rejected this, viewing currencies as inherently vulnerable to shifts in capital flows, trade imbalances, and political pressure. His masterstroke came in 1985, when he amassed a massive short position against the US dollar, believing it was fundamentally overvalued. His bet was not just on economic data, but on political action. When the governments of the world's major economies convened and agreed to deliberately devalue the dollar, Soros netted a staggering $230 million in a single day. This trade shattered the myth of currency stability and proved that a sufficiently large and clever fund could not only predict market-moving events but could also position itself to profit spectacularly from them. As macro traders like Soros played nations against each other, Julian Robertson's Tiger Fund championed a return to stock-picking fundamentals. In an era increasingly dominated by abstract formulas in currency speculation, Tiger's philosophy was deceptively simple: find the very best companies and buy them, find the very worst companies and sell them short. Robertson believed deep, fundamental research into individual businesses, their management, competitive advantages, and financial health was the key to consistent returns. He assembled a team of analytical tigers to scour the globe for these opportunities. This focus on bottom-up, company-specific value was a deliberate and highly successful counterpoint to the top-down, macroeconomic betting of his peers. The narrative further explores how firms like Farallon institutionalized discipline by holding traders personally accountable for losses, creating a culture where risk was meticulously managed. It examines the complex dual role hedge funds play during international crises, sometimes acting as destabilizing villains by attacking weak currencies, and other times serving as heroic liquidity providers, stepping in to buy when others flee. Finally, it confronts the perennial question of systemic risk. While hedge funds can certainly trigger or exacerbate market turmoil, their structure, relying on investor capital rather than massive debt or public deposits, means they can fail without requiring taxpayer-funded rescues. They are designed to be volatile, but not too big to fail in the way a major bank can be. This journey through decades of financial innovation reveals that the greatest hedge fund managers are more than just traders, they are philosophers of the market. They succeed by identifying flaws in conventional thinking, whether it's about the stability of currencies, the predictability of trends, or the value of a single company. Their strategies are diverse, from psychological trend following to geopolitical forecasting to granular security analysis, but united by a relentless pursuit of an informational or analytical edge. The history of hedge funds is, ultimately, a testament to the power of intellectual flexibility and the immense rewards awaiting those who can see the market not for what it is, but for what it might become. Book title: More Money Than God.